So welcome to this lecture series on fiscal and monetary policy responses to COVID-19 and its implications and the implications of presidential elections on future fiscal policy responses. Okay, my name is Narendra Regmi. I'm an assistant professor of economics at UW-Whitewater. This is my second year here. Before here, I was a grad student at Clemson, University, South Carolina. So yeah, I'm excited to be giving this lecture. This is my first time giving this lecture to Fairhaven lecture series. All right, so let's start with the bigger picture here. So you know, the coronavirus crisis is primarily a public health issue, but it also has economic implications. Right? So what are some of the economic fallouts of the crisis and the implications for average citizens like your family, my family? And then we'll discuss about what policy tools do the federal government, the fiscal authorities, and the central bank, the monetary authorities, have at their disposal to prevent a public health crisis from turning into an economic crisis or a financial crisis. Right? And it turns out there are quite robust tools at our disposal, based on fighting these recessions in the past. We have come up with some robust tools that will prevent this public health crisis from turning into a bigger economic crisis. I mean, some economic crisis is inevitable as we go into lockdowns and businesses close. GDP is going to suffer, but the goal here is how to stop a bigger crisis, right? How to mitigate the severity of the crisis here from this public health crisis, right? So let's kind of look at what the unemployment numbers were like back in March when the crisis first started here in the United States. So 3.3 million people filed for unemployment claims from March 15 to March 21. This was the largest single week increase in unemployment claims in American history. The previous record was in 1982, where 700,000 people applied for unemployment claims in a week. So this number was pretty big. The following week, double that amount, 6.6 million people filed for unemployment claims. Right, so I wanted to show you this, and if I'm able to show this here, but here's a cool animation from these guys where they show unemployment claims over time. So 70s, 75, 80s, 90s, 500,000, 600,000. So roughly, 300 to 700, and then here's your 2020. Just keeps going. All right, so that's the 6.6 million unemployment claims there. So and this number has come down like since March. Now we're looking at anywhere between 600 to 700, 800,000 new claims every week. But still, that's a big number compared to what we're used to. Like before this, like I said, the record was 700,000 jobless claims. So if you to give you a sense of the problem here, if you look for Google searches for file for unemployment, over time, I'm plotting here for February 27 to March, the end of March, and you can see how up until the second week of March, pretty low search, and then spikes up in the second or third week, beginning third week of March, the Google search starts to spike up. Right? So gives you a sense of how big the problem was. Let's move on to the stock market here, financial markets. You can see how all four stock indices kind of fell off the cliff in March, the second or third week of March here. right? So the economy, the stock market indices were doing really well up until like mid-February. So mid-February was kind of like the peak for all these stock indices, and then everything fell off the cliff. I mean, this has all these indices have recovered, but not recovered to the old levels. Like they have gotten much better. Actually, Nasdaq, which is the tech heavy index, actually that surpassed its February levels. But the other indices like S&P 500, Dow Jones, and New York Stock Exchange, those still have to recover, right, to the old levels. Well, why does this matter? Well, retirement, portfolios are attached to the stock indices. So, this is directly related to how much individuals are, well, people have direct investment in stock market. That's one implication. The indirect implications is you might have investment in the stock market through your 401k, right? So here's some implications for normal families like ours. Again, another statistic here to show how severe the stock market crash was. So I have the top 10 largest one-day drops, and 2 of those were from March 2020. So you have one on March 16, 2020. The largest one, about 12.5, 13% decline in a single day. And then another one was from March 12, 2020, about 10% decline on a single day. Right? So this is a pretty big movement in the stock indices here. So well, those were some of the economic pictures at the beginning of the crisis. Right? Then what did the government do? What did the fiscal authorities do to kind of mitigate the severity of this crisis? So we have this inevitable recession hitting the economy, right? And you can see all the unemployment numbers, stock market indices. Well, what were some of the early fiscal policy responses from the Trump administration to tackle the coronavirus crisis? So on March 6, Congress passed the first emergency fiscal package worth about $8.3 billion. It was primarily targeted at the healthcare sector to procure like the PPEs and masks and all those healthcare equipments. On March 13, President Trump declared a national emergency under the Stafford Act, which immediately provided FEMA with $40 to $50 billion to combat the virus. And at the same time, another act, Families First Act, provided about $100 billion of tax credits for the sick. Right? So that was the earliest fiscal policy response. But CARES Act was another one that really was up in the media, like everyone was talking about it, because of how big it was, $2 trillion. Right? Just to give you a sense of how big that number is. I mean, it takes 32 years to count to a trillion. So $2 trillion, it would take like 64 years, right? So 2 with 12 zeros. And the CARES Act was first, started in the Senate, and then it was later on approved by the House and signed into law by President Trump on Friday, 27th March. And again, this act was meant to help individuals and businesses weather the storm when they might be lacking income and revenue. Right? So what was in the CARES Act? Right? What were the big things in the CARES Act? So here are the big components of the CARES Act. There was tax rebates for individuals and families, beefed up unemployment benefits. Right? This is unemployment benefits. We've never seen unemployment benefits like this before. There was also a paycheck protection program primarily meant to help small businesses. There was also aid to airlines and travel industry. These were the industries hit pretty hard by the pandemic, and there was support for these industries. And then there was also aid to state and local governments. I mean, there was more than just these, but these were the main components of the CARES Act, right? So as you may know, CARES Act provided $1,200 for individuals or $2,400 for married couples for incomes below 75,000 for individuals and 150,000 for married couples. Also, this was also known as, commonly known as stimulus checks. Right? And then parents also received $500 for each qualifying child. So a family of four received up to $3,400. So if you're making under $150,000 as married couples, then you received up to $3,400 in this one-time tax rebate program. Right? So additional component is this unemployment benefit. Like I said, beefed up unemployment benefits. So states are responsible for providing unemployment benefits in normal times, but on top of that, the federal government stepped in and added this $600 per week for up to 16 weeks. I think this ended in July, end of July. So let's say if somebody was getting $200 from their state, well, the federal government was paying additional $600, so that's $800 per week, so $3,200 per month for at least for that 16 weeks. So and the rationale, well, another thing was usually gig workers like Uber drivers and these gig economy workers would not be eligible for unemployment benefits, but this time around they were made eligible, right? And independent contractors were also eligible, which they were not before, but now with this new CARES Act, they would be eligible. The same goes for self-employed folks as well, right? So again, rationale pretty simple. Extremely difficult to find a job. Even if you want, looking for a job, businesses are closed because of mandatory shutdown. So even if you worked really hard to get a job, you wouldn't be able to get a job because of so many businesses shutting down, right? So what else? There were some provisions with retirement accounts that you could borrow up to $100,000 if you're less than 59 and a half years old. Usually there's a 10% penalty when you do that, but this penalty was being waived. And then the condition was, well, you or your family members were affected by this COVID pandemic in some way. All right. So what else for families and individuals? Well, suspension of student debt payment for 6 months, and to see how big an impact that's going to make. An average family pays about $180 a month towards student debt, right? So although not super significant, but when you don't have job, well, every penny matters, right? So again, not to be confused with loan forgiveness. So this is not loan forgiveness, rather this is just postponement of your student debt payment. Okay? And then there's no additional interest that will get accrued because of this. And there was a big debate between Democrats and Republicans with this provision. Democrats wanted an outright cut of student loans, whereas Republicans were for delaying payments. Right? So another big component, and this was pretty popular, called Paycheck Protection Program, and small businesses could get loans from the government or from the Small Business Administration. That was the agency that was taking care of or doing the operational or taking the operational aspect of the Paycheck Protection Program. So about 349 should be billion, not million, right? So about $350 billion program, where small businesses could go to their banks and to apply for these loans, and then these banks will cooperate in collaboration with the Small Business Administration, would give loans to small businesses. And the idea is, as long as these businesses kept a certain percentage of their workers' labor force intact, these loans would be waived, right? So you could use this for anything like mortgage payments for other type of bills, as long as you retained a certain fraction of your workers. So it was again meant to keep employment at high levels or reduce unemployment levels, right? So another so that was the unemployment benefits here. And here are these conditions that I talked about. So again, like I said, the primary objective was to help these businesses. It's a safety net for small businesses, and the secondary objective was to protect employment. Right? So what else in the package? There was also aid to airlines and travel industries. So airlines received 29 billion in grants and 29 billion in loans and loan guarantees, but the funding came with some strings. So these airlines who got this grants and loans were not allowed to engage in stock buybacks. And then there were also limits on executive compensation, I believe up until 2021, and there was also some dividend caps that they were doing, and yeah, so some strings there. And there was a big debate with aid to airlines and travel industry. People, some critics of this program was saying, well, these airlines were doing really well in terms of their profitability from I don't know 2012 up until 2019 or right before the pandemic, and why didn't they, why didn't they make like funds? Why didn't they set up funds for rainy day funds? Like why didn't they set up rainy day funds? And then and they were expecting. I mean, everyone expected a recession, was oncoming, be it this year or next year. Why aren't they setting this rainy day funds when they're doing really well, and then having the government bail them out during difficult times? I mean, there is some truth to that argument, but again, the extent of the pandemic and the force by which it came, how fast it came, was really unanticipated. So my take is, I think this was justified. The aid to airlines and travel industry was justified, because nobody really expected a pandemic of this severity to hit the U.S. economy and just take the economy off the cliff here. Right, so more components here. There was also assistance for state and local governments worth $150 billion. And then why is this important? Because states have limited capacity to borrow, and a lot of states also have these budget balance requirements, right? So their cost is going up because of health cost, hospital cost, public safety measures. But at the same time, revenues going down, right? So you have cost going up, revenue going down. So there's a big hole in your budget. So the federal government stepped in and helped with filling the gap there. But as we'll talk about in a little bit, for the next package, which hasn't come yet, but this is another contentious issue. The Republicans are against giving state and local governments a lot of money, whereas Democrats want to provide a decent amount of funds to the local and state governments, and we'll talk about that when we talk about what new packages are about to come or are being discussed in Congress, right? So again, big problem. Was this enough? Probably not, because if you look at the Paycheck Protection Program, on Friday alone, the first Friday after the program was implemented, Bank of America received more than 10,000 applications for small business loan within the first few hours. And this money, the 350 billion pool of money was empty within days. Okay, so and again, $150 billion. Was this enough for states to cover their health care and other expenditures? No, because New York already spent like over $15 billion on COVID-19 related healthcare within the first week, right? So yeah. And now I want to kind of move on to, well, where did the $2 trillion come from, right? So the U.S. Treasury will have to borrow it, over the coming months, and in fact they already did by selling bonds to investors in the Treasury market, right? So this is Treasury bills are securities issued by the federal government, and investors will buy them, and if there are any remaining leftovers, then the central bank will take up the rest, right? So they'll buy the rest, right? So here's the, so that kind of leads us to monetary policy, central bank. What is the role of central bank? And again, monetary policy will look at few tools of monetary policy. So what were some of the monetary policy measures implemented by the central bank to help with this crisis? So these were the big ones. Interest rates, the interest rate that the central bank targets, also known as the federal funds rate. This is the overnight lending rate between banks. So commercial banks are borrowing and lending money to each other, and there is an interest rate that prevails in their market, and then that's the interest rate that the Fed is trying to target, and that interest rate was slashed to zero. The Fed also acted as a lender of last resort by providing funds to financial institutions that are in trouble, like that need liquidity. They are telling them, hey, we are here for you if you need additional cash, additional liquidity. And new facilities, lending facilities, were also set up to facilitate the smooth flow of credit in the economy. And there was something called Main Street Lending Facility, which was quite new. We didn't have that during the 2007-2009 crisis. And the idea with the Main Street Lending Facility was to help small businesses. Like usually, whenever we think about the Federal Reserve, we're thinking about like big, treasury bonds, stock market, financial market, treasury securities. Is there anything for small businesses? Well, besides the interest rate, which will eventually affect the cost of borrowing for small businesses, there's, they also set up a lending facility where small businesses could directly, get loans from the Fed. I mean, there were banks doing the intermediation, but the idea was this is much different than going to your bank and applying for loans. So the conditions on those would be very strict, whereas the conditions on this Main Street Lending Facility that was facilitated by the central bank, the lending terms were much better. Right, so like I said, target interest rate was slashed to zero. So the Fed was going all out, also acted as lender of last resort. So there were some problems in the Treasury securities at the beginning of the crisis. During the second, or I'm going to say third week of March, there were some issues with the, actually the second week of March, there were some issues with the Treasury market. And this is the market where Treasury securities, the U.S. government issued bonds, are bought and sold, and this is the safest haven in the world. Like people have the utmost trust in these securities, but there were some disruptions in the Treasury market, and this is the bedrock of the global financial system. So if there are disruptions in the Treasury market, well, there's going to be disruptions in other markets, and the whole financial system is at risk. So in order to stop that, Fed stepped in, the central bank stepped in, and when I say Fed, I'm talking about the Federal Reserve. They stepped in and they bought these Treasury securities, and the problem specifically was with the fall in the stock market. A lot of investors were deprived of cash, like they were cash strapped. Right, so there was a massive sell-off of these, not only risky assets like stocks, but also like risk-free assets like Treasury securities, and that caused this massive panic in the Treasury market, and Fed stepped in and injected additional liquidity, additional cash, by just buying these treasury securities from these investors, right? They were also supplying them loans using these treasury securities as collaterals, and yeah, so these things were done by the central bank. They were also working on primary corporate credit facility for businesses. So basically buying. So let's say a business, let's say Coca-Cola, is in need of money. They wanna issue bonds. If they can't get enough buyers for those bonds, well, the Fed is going to pick up the leftovers, right? If they can't find investors to buy their bonds, they'll pick up the leftovers. And this was a pretty successful program as well. But again, the Fed, one thing I want to kind of add here is the Fed is not going to buy any type of bonds. Like, there were some conditions. You had to be, investment grade. You had to meet a certain criteria. Your company had to meet certain financial criteria before March 23rd, right? So if you were a junk bond, if investors, if the rating agencies were classifying your bonds as junk bonds, then you wouldn't qualify for this program. Right? Now let's now kind of think about, so those are the fiscal policy responses, monetary policy responses. Now let's think about, well, what new packages can we expect, or what new packages are being discussed in Washington. There hasn't been a new, so just to give you a preview, there hasn't been a new legislation that was both acceptable by Democrats and Republicans. However, Republicans and Democrats have kind of passed their own legislation. Of course, Republicans passed something called the HEALS Act in Senate, but didn't go through the House. And Democrats passed their own HEROES Act in the House, but didn't pass in the, this act didn't pass in the Senate. So, but this, the reason I bring this up is kind of, this illustrates the issue, the contention issue of like, what are some of the big things they have been debating on, right? So the biggest point of contention between Democrats and Republicans are the following, right? So, well, liability protection to shield businesses from lawsuits involving COVID-19 related illnesses and more. So Republicans want this liability protection, whereas Democrats want to use OSA to take care of this. So more protection for workers as opposed to businesses. Similarly, funding for local and state governments. Democrats want to provide a lot of funding to state and local governments, whereas Republicans are against providing a lot of funding. And their idea is we should not be using this pandemic time to take care of their budget imbalances, right? So some of these blue states may be having these budget imbalances from last year, the year before, and why should we be taking care of those budget imbalances under the pretext of this COVID pandemic? Well, that's their argument, right? So they're against giving a lot of funding for local and state governments. And similarly, unemployment benefits. So Democrats want the same $600 per week federal contribution, whereas Democrats want much lower unemployment benefits. They want, or at least in the HEALS Act they passed, it was only $200 per week. Right? So and there are other areas where they disagree as well. And this New York Times interactive chart kind of shows where what the difference is in terms of the final amount, and kind of gives you a breakdown here. So the Republican plan was about $1.1 trillion, whereas the Democrats' plan would cost us $3.4 trillion. And Republicans wanted the small business aid worth $200 billion. So this is similar to the Paycheck Protection Program we talked about. Democrats don't have that in their bill, but Democrats are for more stimulus checks, right, for families and individuals. Right, so you can see stimulus checks for them, the cost was about $436 billion, but for Republicans it's only about $300 billion. Again, another point is point of contention is healthcare. Democrats want a lot of spending on tackling the virus. So $382 billion they want to spend on tackling this virus in terms of the healthcare cost, whereas the Republicans only want to spend $111 billion. Unemployment benefits we talked about. Democrats want to spend $437 billion on unemployment benefits, whereas Republicans only want to spend $110 billion. You can see the state and local aid, that's the biggest one, right? The Republicans only want to spend $105 billion, whereas the Democrats want to spend over $1 trillion supporting state and local governments. And then another argument put forth by Democrats for why we should be giving more money to state and local governments is a lot of employment takes place at these local governments, state governments, and then a lot of institutions are also dependent on their funding. So a lot of universities depend on state funding. So they would need more funding, is at least what their argument is. And then safety net and other tax cuts. Well, Republicans don't really want to spend much on safety nets, whereas Democrats want to spend a whopping $736 billion on safety nets. Okay, so where do we are hoping something will pass before the election, but unfortunately, there wasn't an agreement between Democrats and Republicans. It looked like at some point they said it looked like it was going to pass, and things stalled again. So, but where do things stand right now? After the introduction of the vaccine, after the vaccine news by Pfizer and BioNTech, and then good news on unemployment. So unemployment numbers have dropped significantly. The new unemployment number is about 7%, 6.9%, from a peak of over like 20% back in March. So we have done pretty well. So back in March, we lost about 22 million jobs. We've recovered more than half of that, but we're still about 9 to 10 million short compared to before the pandemic. So there's a lot of work to be done, but we've also made some significant progress in the labor market. But it looks like the other half is the most challenging half. Right? So as businesses start to reopen, people going back to businesses, these unemployment numbers are going down. But what do you do for travel industries, entertainment industries, and not a lot of people going to movies right now, right? So people working in theaters, or travel like airlines, or hotels, like a lot of virtual conferences, not a lot of vacation. So a lot of jobs in these service-oriented industries are being affected. And another worry is this service-oriented jobs usually have people with lower educational qualifications. So minority workers, a lot of minority workers, and young workers. And the worry is that these young workers use these jobs, like working at restaurants, as stepping stone for their career, and if these jobs are not recovering, then we'll have a young generation that is deprived of this opportunity to work, make money, go to school, and their future will be affected, right? Right, what does Majority Leader Mitch McConnell want? He wants a very smaller, highly targeted bill, whereas Speaker Nancy Pelosi, she wants a bigger bill, so less than the $3 trillion, but still pretty significant compared to the Republicans. $2.2 trillion is what she wants, right? All right, so now we know the election results. So now, hope we we get a stimulus package. I think the economy really needs a stimulus package right now to aid small businesses, to aid families, so that we are helping them weather the storm. Now kind of move on to like what does the Biden administration mean for taxes? Right, so this is the presidential theme series. So let's talk about, well, what does it mean for taxes? So this is what Biden's campaign has been talking about. So they said they would eliminate Schedule 199A, and it'll most likely be eliminated. And the idea with Schedule 199A is it allows non-corporate taxpayers a deduction of 20% of qualified business income earned in a qualified trade or businesses. And this was a provision added in the 2017 Tax Cuts and Jobs Act, and the Biden administration will most likely eliminate this. Additional, so what does it mean for individuals, like in terms of the income tax rate? So here's the brackets here, tax brackets. So Biden is proposing raising the top individual income tax rate to 39.6% from its current level of 37%. It used to be 39.6 before the 17 Tax Cuts and Jobs Act, but it was reduced to 37%. Then now he wants to raise it back to 39.6%. So the folks will be affected the most would be these high income earners. So anyone making over 500, for single individuals making over $518,000 or more, or for married couples over $622,000, they would be paying about 1.4% is more in the marginal tax rate here. Right? He also said he would limit the value of itemized deductions. So these are the write-offs that households can take on expenses that include medical costs, giving to charities, and so on and so forth, to only 28%. Right? For households with income exceeding $400,000, according to an analysis from the Tax Policy Center. Biden has also called for raising the corporate income tax to 28% from the current 21%. Again, this current 21% was due to the Tax Cuts and Jobs Act of 2017. Biden's also proposed raising the capital gains rate to 39.6% for incomes over $1 million. So currently, depending on your income, an investor could face long-term capital gains tax rate of either 0%, 15%, or 20%. Like I said, depending on the income. But now he wants to tax capital gains with the individual income tax rates. Right? So these 39.6% was the individual income tax rate here. He wants to raise that for high income earners. Right? Biden also would like payroll taxes to go up for earners over $400,000. So currently, wages up to $137,700 are subject to the Social Security tax. Now Biden wants to subject incomes up to $400,000 to the Social Security payroll tax. Okay? He also wants to bump up the top tax rate on state transfers to 45%. Now in 2020, an individual can pass on up to $11.58 million to their heir without facing federal, state, or gift taxes of 40%. But now he is reducing that limit down to $3.5 million. So anything beyond that, you face this 45% tax. And then he's also limiting the exclusion to $1 million for gift taxes. And this is based on analysis made by the Tax Policy Center. So let's kind of move on to the revenue effects. So what does it mean? What does this new tax plan mean for the revenue for the federal government? So we can see that if we go from 21 to 2030, so the second last column here, this tax plan is expected to, according to the Tax Policy Center, again, the analysis made by Tax Policy Center using their micro simulation model, this plan is expected to generate about $2.1 trillion for the federal government, right? $2.1 trillion. Right? And here's the breakdown of what's going to happen in 2021, 2022, all the way down to 2030, and then that's the aggregation. This second last column is the aggregation, and then 2031 to 40. These are again another projection. So if these this plan is to continue, well, by 2031 or 2040, during that period, we're expected to generate, or the federal government is expected to generate about $4.3 trillion in revenues. Right, so most of the revenue, it looks like, looking at the numbers here, most of this revenue is coming from high earners, like individual income and payroll taxes. They contribute, like if you look at the numbers from 2021 through 2030, except for the first 2 years, if you go towards the later years, from 24 through 30, most of the revenue from the government is coming from individual income and payroll taxes, meaning the income taxes at the very top, and then also payroll taxes for folks making over $400,000. And then business taxes also contribute a major portion of revenue for the government, whereas state and gift taxes don't contribute as much, but still they contribute a decent amount, right? And now, well, given this new tax plan, what is the distributional effects? Right, let's look at what is the effect on different income earners. So here's the distributional effect from the Tax Policy Center, and they do this for year 2022 and year 2030, and as you can see there, the first 4 quantiles, so let's look at 2022, the first 4 quantiles benefit from the tax plan. Right? The biggest beneficiary of this tax plan is the first quantile, and about 5% increase in their income, right? And then about 2.5% increase in income for the second quantile, and about, I don't know, 1.5% is for the third quantile. But the last quantile is actually seeing a negative, about 5% fall in their income. Right? If you flash forward to 2030, the benefits are not as high. The benefits are significantly dampened, but still on the benefit side, but the cost side isn't that different. Right? The top quantile is still facing about 4% decline in their income. And then you can also see the fourth quantile is also seeing a fall in their income in 2030 as opposed to an increase in income in 2022. Right? So these are the distributional effects here of a Biden tax plan. But it really depends on whether this will go through, and what portion will stay and what portion cannot stay will really depend on that Georgia runoff elections, and that will decide who will take control of the Senate. Right? So if Democrats end up taking control of the Senate, well, probably most of these will pass and become law. But if Democrats are not able to take control of the Senate in January, then the story might be slightly different, and there will be some compromises. So we'll see anything in between the status quo and what the Biden's campaign is proposing their tax plan is going to be. So we'll really have to see what the election results will tell, and that will determine the fate of our taxes next year and years going forward. And I hope we get a new stimulus bill for the economy to heal the economy. We are still not out of the woods yet. We're still struggling, And like I said, yeah, the first half of the, the jobs that we lost are already back, but getting that second half is the most challenging task. And as we, if you look at the jobs numbers, back in May, month of May, we added 2.5 million jobs, but fast forward to October, we only added about 600, 700,000 jobs in the U.S. economy. So the gains are starting to kind of peter out, and hopefully there is some compromises on either end to come up with a plan and with a stimulus package that will really help the economy at this point. And there's only so much that the central bank can do, because they only have lending powers, they don't have spending power. So all they can do, and they've been throwing the kitchen sink at this problem, like they're going all out. But now it's really up to the federal government and the legislative body to really work on a new plan that will help help the economy get through this pandemic. Right, so that's all I have, and I hope you enjoyed this talk, and I look forward to giving more talks in the future. Thank you.